All right. I just take the link also in my phone so that if anybody is messaging me on YouTube, I should be able to view it, and then we'll start off. Okay. Perfect.
Good morning, sir.
Good morning, everyone. All right. I'm live on YouTube also. Perfect, friends. Can we start off now? So friends, today we'll have a full day session where we'll be covering the RTP and MTP. So I'll be going at a good decent pace so that we all can understand also. At the same time, I can cover maximum amount of areas also. All right. So we'll do these problems, and in the end of the class, I'll share the handwritten notes in my WhatsApp group so that if you are unable to cope up by writing with the entire thing, you will be always having the handwritten notes available with you. All right. Yes. Uh, Sarvamangala, you want me to share the YouTube link where? You want me to share it in the group?
Yes, sir.
Okay, 1 minute.
Good morning.
Yes. All right, friends. Let's do it now. So 1 minute. Let's start off now, friends. I believe I've shared the link also. Okay. RTP MTP session. All right. So let us start off with the RTP first. All right. Yes. Friends, if you go through the RTP, one thing what you would realize is that most of the questions that we have done in our regular class or in our crash class are either covered straightforward in the RTP, or it has come by way of an adjustment question where conceptually we have done exactly the same thing. Okay. The major highlight of this RTP is that the first two questions are actually theory driven questions. So the MCQ has not come by way of a normal question. It has come by way of a theory with multiple options. All right. So we'll discuss these two questions and do these two questions together first. We'll start with question number 1. So let me just write down over here question number 1. Question number 1 of RTP. Ready? All right. Growmore Limited, an NBFC, is in need of funds, and hence it sold its receivable to Mac Finance Corporation. So I need to draw a chart to understand this. There is a company called as Growmore. All right. This Growmore has sold its receivable. It has got debtors, which it is selling it to MFC, that is Mac Financial Corporation. All right. For a value of 100 million rupees. Sell its receivables. All right. MFC creates a trust for this purpose called as General Investment Trust. This is a trust created by MFC through which it issues securities carrying a different level of risk and return to the investor. So they will issue securities. All right. Having a different level of risk. Further, the structure also permits GIT to reinvest surplus funds in the short-term plan. So when they receive money from the investor, there will be some investors over here. When they receive money, they can use it to pay to grow more. And the balance money what is available can also be reinvested. All right. Then When they come down, they tell that the further the structure also permits GIT to reinvest surplus funds. MFC also appoints a third party, Safeguard Private Limited. Okay. SPL to collect the payment due from the obligors and passes it on to. So here basically what they will do is they will be collecting funds from the obligors. Here means debtors. Receivables are one form of debtors or receivables. Am I right? 1 minute, friends. Okay. So they collect the money from the obligors. All right. And they pass it to whom? Pass it to GIT. It will also follow up with the defaulting obliger and if required, initiate appropriate legal action. So basically, in this example, this one particular party is who will be your collection agent, or we call him as the receiving or collection agent. All right. And this entire thing is created by whom? MFC. MFC is the one who created GIT. MFC is the one who actually bought the receivables from Growmore. And MFC is the one who actually created SPL also. So in our terms of factoring the securitization chapter, MFC over here will become your originator. All right. Now, I think I've given you two terminologies. Now, let us read through the questions one by one. Can you first draw this diagram in your books, friends? All of you? All right. Are you all done with this, friends? Now I'll explain to you. Here, they are asking the following requirements. Interact and tell me the answers. The securitized instrument issued for 100 million by the GIT falls under the category of there are 3 to 4 types of instruments. Pass through security, pay through security, stripped security, and the last one is debt fund. Friends, I had taught you what is pass through certificate, or sorry, pass through security. Pass through would mean the money would be received over here and directly it will be given to whom? Gromo. Pay through security is when they issue a new form, who are issuing new securities to the investors having a different form of risk, then they are collecting money and offering it over here. All right. So tell me, friends, in this case, is it a pass through certificate or is it a pay through security? Here there are securities involved, so it is pay through security. So the answer for the first one is going to be what? It is going to be option number B. It is not stripped security, because stripped security, what they will do, if you have, I'm not sure if you have gone through my theory marathon that I have already offered to all of you. In the theory marathon, I have told that stripped security has got two parts, principal only, interest only. So they strip the complete receivable into two parts and they give it separately. Here, nothing like that is happening. And debt fund is a normal debt fund. So the receivable or the scenario over here can either be pass through certificate or pay through security. But here it is termed as what? It is the pay through security. So the first one, the answer would be option number B. For one, the answer would be B. Now tell me the second one. In the above scenario, the originator is, come on, tell me, friends, who's the originator in the above scenario? I think I just gave you the answer over here. Who's the originator?
Mercy.
MFC is the originator. All right. And the third question that we spoke over here is that GIT, the General Investment Trust that is coming over here, that is this General Investment Trust, is going to be what? Is it the obliger? Yes or no? No. Obliger are the receive debtors. These people are who we call it as the obliger. So they are not an obliger. Are they originator? No, because MFC is already the originator. Okay. Now, are they special purpose vehicle or are they receiving and paying agent? Tell me, we already have this SPL is what we call it as receiving and paying agent, or we call it as a collection agent. So what is the only thing left over here? It is a special purpose vehicle. Everybody clear? So the answer for GIT over here is they are going to be special SPV, or a special purpose vehicle. All right. Last one. In the above scenario, SPL is okay. I think we spoke about this. No, in the above scenario, SPL, that is SPL is going to be what? It is going to be receiving and paying agent. So friends, the answer for option number 4 is going to be what? D. So I think I'll just change the terminology over here. Rather than calling it as a collection agent, let me call it as a receiving and paying agent. All right, SPV, this one is going to be the originator, and the entire thing is what we call it as the pay through security. I'll give you a minute. If you're not done drawing the chart, please draw it in your books. After that, we'll go to the next question.
Sir, excuse me, sir.
Yes, tell me.
Sir, I have one doubt, sir. First question, pay through securities. They are collecting funds from the debtors also through the SPL, and through MFC, they are paying to grow more. So it can be a pass-through security also, is it, sir?
Pass through security would come if there is no, sorry, it's not pass through security. What is the terminology that is coming over there? Pass through certificate. All right. If it's a pass through certificate, they will directly issue certificates. They will not be issuing securities over there. All right. And the security will give a direct right that the amount that is received over here will be passed through whom? Passed to Gromo. All right. Here they are having a right to issue a separate form of securities, which is having a different form of risk also in the market. Yes, that's right.
They are collecting funds from the debtor and through SPL also. So it can't be, because they are giving issuing securities, it cannot be a pass-through certificate.
Yeah, because of pass-through certificate also you collect money. Pay through security also you collect money. It's only different forms of collecting money.
Okay, sir.
Yeah.
Thank you, sir.
Thank you. All right, friends. Are you all done
Sir,
writing?
I have a doubt.
Yeah, tell me.
Sir, is MFC the originator or Gromor the originator?
Okay, I think I got it. I was about to reply to your message. See, now Gromor is the in the examples that I gave in the class ideally. Gromor is ideally the same person who may also be MFC in the examples I have given in the class. All right. Here, Gromor has a receivable. So Gromor is coming to MFC and telling, see, I have a receivable. I'm not able to manage it. Can you help me out with this? So now MFC, what he's doing is he's going to create GIT. He will create SPL. He is going to do all the collection money and give it to Gromor. All right. So the idea has been originated from Gromor, but the original transaction originator is whom over here? It is the MFC.
Okay, sir. Thank you.
All right. Yeah. Thank you. Yes, friends. So I think we are done with question number 1. I think there's one more requirement. Which of the following statement is true? Okay. When the yield to maturity rises, so friend, discount factor, YTM is discount factor. Yield goes up, the principal price will go up. Or you don't think about this as PO security, just think of this. If the yield goes up, will your present value go up or will it come down? It will come down. So if the present value comes down, the present value of PO security will also come down. So this security is true or false? This security is false. It is not true. Okay, this is false. Next one. When YTM in the market goes up, the price of the PO securities tend to fall. Yes or no? When the YTM discount factor goes up, the price will fall down. Okay, so this sentence is actually correct. All right. Third one. When the YTM in the market falls, price of the PO security falls. Yes or no? No. When the yield falls down, the price ideally goes up. Everybody clear with this part? Okay. Last one. When the YTM in the market falls, the price of PO securities remain the same. No. When the YTM falls, the price actually goes up. So tell me, friends, which is the correct answer in all these things? B is the correct answer. Okay. That when the YTM falls, the price goes up. All right. Perfect, friends. So I believe we are done with the first MCQ. So friends, this was a theory-oriented MCQ and it was a very good one because so far we never had a case study on securitization. But now they have brought in a case study. So with this, securitization chapter will become even more elaborate and more understandable. All right? Yes. Can I go to question number 2 now? Okay. Question number 2 is a question on security analysis. Friends, in the security analysis, they have actually taught you different types of tests. If you have gone through my theory, you would know that. Now here they have a practical scenario given for that. First test that you had to learn over there was run test. The second test that you had to learn is called as a serial correlation test. Okay. And there was one more test, friends. Hold on. There's a filter rule test. Okay. That was the third one. Filter rule test. That is the third one. All right. So basically, run test, we have done a problem also. There's a question in your books where what we do is we will take the number of positive signs, then we will take the number of negative signs. Okay. And then we will take the number of sign changes. After we do this, we will take the mean and we will take the standard deviation and then we will work out based on 95% confidence level, etc. Friends, this is done in security analysis. The second question which we have done in the class, study material question itself. Serial correlation test, what they will do is they will take the past data and they will observe the trend. Okay. Based on the trend, they will take a decision. That is what you call it as a serial correlation test. Filter rule test means they will give some conditions. Based on the conditions, they will filter out what doesn't fall in the condition. So what remains will form a part of the hypothesis. So these are the three types of tests that we have learned, friends. Run test, serial correlation test, and filter rule test. Quickly, can you scribble down this in your books now? All right. Now that you're clear with what is going to happen over here, let us go and discuss the problems part. Okay. Yes. So let's read the first test number 1. For the past 5 years, you collect daily price changes. You calculate the correlation coefficient for different of the lag periods. Analyze whether the past price changes exhibit any correlation to the future. You considered the price changes to be serially independent. The result indicated that most autocorrelation coefficients are close to 0. Friends, correlation +1 means what? They move in the same direction. Correlation -1 means what? They move in the opposite direction. Am I right? So they are saying that, suggesting that the past changes do not affect the future. So past data and future data are completely different is what they are doing. Now tell me, test number 1 is what test? Is it serial correlation test, filter rule test? Is it run test or variance ratio test? I think you would have understood by now it is going to be serial correlation test. Point number A is going to be the answer. All right. Now let's go to question number 2. You further investigated the randomness of the price changes in the XYZ stock index, analyzing the daily sequence of price changes. You count the number of runs where price changes are positive and negative. Upon comparing the observed number of runs with the expected number of based on randomness, you find that they align closely, supporting the idea that the price changes follows a random pattern. Friends, we have done problems on this one also. It is a run test, exactly. Okay. So friends, first one is serial correlation, second one is run test. So ideally, the third one is supposed to be, using your common sense, you know the answer. It will be filter rule test, but let's read through it. To examine the efficacy of the trading strategy based on historical price, you implement a simple trading rule. for XYZ stock index. The rule involves buying when the price crosses, a moving average of 5. So if you're filtering it above 5 only, you will take it. And selling it when the crosses 7 threshold. Over a period of testing, you compute the returns generated by the trading strategy. The results reveal that the returns are not consistently better than random chance, implying that the past trend do not reliably predict the future movement. So friends, all the three are giving you the same conclusion. Past data never can be used for predicting the future. So third one is what you called as filter rule test. Okay, you don't have anything to learn called as variance ratio test as of now. These are the main three tests that you have to learn. All right. Now, down, after conducting the three tests, the evidence supports weak form of efficient market theory. Weak form means past data do not help you to predict the future. That is called as a weak form. All right. And you concluded that past prices do not reliably predict the future movements. Okay, so now we'll go to the fourth question. The filter rule test should not be applied for buy and hold strategy if the filter rule test should not be applied in the following four scenarios. Let's read the scenarios one by one. The behavior of the stock price changes predictable. The behavior of the stock price changes dependent on the past trends. The behavior is correlated. Last one, the behavior is random. According to you, what is the answer, friends? When are we not supposed to apply the filter rule test? Rahul says B, Yamini says B. The behavior of stock price changes is dependent on the past trends. Can I just cross-check this answer, friends? I just don't recall this one. Let me just take the solution. Point number 4. D is the answer. Okay, not B. I got a bit confused because when the data is not connected, only that time filter rule test cannot be used. If the past data is connected with the future, you should be able to use filter rule test. All right. So friends, the answer for this question is going to be D. The behavior of stock price is going to be random. All right, friends. Last one. The results of your study support which theory? Friends, there are following theories are there. Semi-strong theory, strong theory, random walk theory, Markowitz theory. What do you mean by weak market hypothesis, or what do you mean by semi-strong theory? All the information can be predicted to a limited extent. Strong theory means I can predict entire future outcome. What do you mean by random walk theory, friends? Market can never be predicted. So now tell me over here, friends, can you predict the market in reality? Over here, the market cannot be predicted. So what theory is applicable over here? Random walk theory. So friends, we are done with the two MCQs that you have in your RTP. Shall I go to the next part now?
Sir, excuse me, sir.
Yes, tell me.
Sir, first question, could you please
Yeah.
explain? Sir, I couldn't understand that first one.
First one, see
Yes,
what's
sir.
happening is you just read it like this. I'll just read and explain to you. You are collecting the daily price changes. Okay. You calculated correlation coefficient. Okay. So for different lag periods and analyzed whether the past changes exhibit any serial correlation with the future. So you are tracking the data of the past and you're checking whether that data is, usable in the future. All right. So that is why we call it as serial correlation test.
Oh,
Okay.
okay. Thank you, sir. Thank you.
Thank you. Shall I go to the next part now? So friends, now two theory problems are over. Now we have to do problem-driven areas. Problem-driven areas, friends, conceptually and many problems have come from the study material or from the material that I have given you in the class. So they will be easy for the students who have attended my class. We are going to go slow and we'll go logically so that even if you have attended my class or not attended my class, doesn't matter. These classes will be useful for both of you. All right. But it will be easier for all of the people who attended my class because you would have done these problems already. Okay. Shall we now start off? Yes. Derivatives, question number 3. Question number 3. Mr. Shyam, an investor, is not sure about the expected price movements of the stock of Delta Corporation's share. His friend Adi advised him to go for option contracts if he wants to play in the market with limited risk. Adi advised him to follow the below mentioned strategy. Purchase a 3 months call option. So friends, I'll just put a table over here, particulars. Okay. First one is buy call. Am I right? Buy call with a premium of how much? 30. So I'll put the table over here. Okay. S1, E1, action, GP, premium, net profit. Okay. Buy call with a premium of 30. And what is the exercise price they have told over here? 550. Okay. Purchase a 3 months put. Buy put. Friends, buy call, buy put, there's a name of the strategy. What is the name of the strategy? Can you tell me? It is a straddle. Okay. And you're paying a premium of how much over here? 5. Okay. Now they are saying that currently the stock price is 500. Current stock price relevant or not relevant? Not relevant. Only the future stock price is relevant. Now they are asking, demonstrate the net payoff for Mr. Shyam at the expiry of the option. If the price happens to be no change, falls to 350, goes up to 600. Okay. So now what I'll do, I will take situation number 1 over here. Working note number 1, price remains the same. Okay. So now tell me, if the price remains the same, your S1 will be 500 and 500. So now tell me, you have a right to buy at 550. Outside market, you're going to buy at 500. Will you exercise or will you lapse? You are going to lapse. All right. So once you lapse it, your GP becomes 0. Premium will be 30 and your net profit will be minus 30. Now other one, S1, E1, you have a right to sell at 450. Outside market 400. Exercise or lapse? Lapse. Again, you will get 0, minus 5. Okay. Then you will get the answer as minus 35. Okay. Everybody clear with the first one? Next one I'll write down. Price, they have given the second scenario. What have they told? Price falls to 350. So again, I'll draw the same table. S1. We will have E1, action, GP, premium, and net profit. Okay. So what is the first thing we have done over here? Buy a call. So you have bought a call at what price now? Falls to 350. 350, 550. And similarly, what did you do? Buy, put 350, 550. Now tell me, you have a right to buy at 550. Outside market 350. Exercise or lapse? Lapse. Here it will become 0. Premium you have to pay 30 minus 30. You have a right to sell at 550. Outside market 350. Exercise or lapse? Exercise. So here you'll make a profit of how much? 200. 195. Do you make a profit of 165? Friends, they are dealing in lots of 100. So if I do 35 into 100, do you get the answer as 3,500 over here? Okay.
Excuse me, sir.
Yes, tell me.
So the buy put, the exercise price is 450, sir.
The exercise price is 450, is it? Oh, thank you for correcting me there. It is 450. So you'll get a profit of how much over here? 100. You will get a profit of 100 minus 5, that will be 95. So profit will be 65 into 100, that will be 6,500. Am I right? Okay. Next one. I'll write down the next working note now. What is the third scenario they have told over here? Price goes up to which one? Goes up to 600. So once the price goes up to 600, I will again draw the table, particulars. S1, E1, action, GP, premium, net profit. Okay. So you are having two things over here, buy a call, and the second one is buy a put. Okay. So when you buy a call, the price is now 600. Here it is 550, right? 550 and 450.
Yes, sir.
Right to buy at 550, outside market 600. What will you do? Exercise. You get 50, premium is 30, you make a profit of 20. Right to sell, you will lapse, correct? And you have a premium of how much? 5. So you get the answer as -5. 15 into 100. Do you get the answer as 1500 over here, friends? Perfect. I'll give you a minute, scribble down, then we'll go to the next part. Hmm. All right, friends. I'll be sharing these notes with you if I am not slowing down a bit too much, because then we'll not be able to complete many questions. All right. So you can scribble along with me, and then I will be sharing this handwritten notes at the end of the class with all of you. Okay, friends. Can I go to the next one now? Okay. Now let us take question number 4. It's a question on futures. 1 minute. Question number 4 is on futures. So here the price of ACC stock as on 31st December was 220. So we'll start with the basic data. Working note number 1, basic data. So here they have told the stock price is going to be 220. So I'll write down S0 is equal to 220. All right. And then they have told the future price of the same stock on the same date for March is 222. So F0 actual future price is going to be 222. Okay. Point number C, other features of the future contract and related information are given below. The duration is given as how many months? 3 months. Duration is 3 months. Borrowing rate is 15% per annum. Borrowing rate is 15% per annum. Dividend they have told over here as 25%. Friends, here there can be two assumptions, okay? They have not used the word dividend rate or dividend yield, but your textbooks have done it assuming it to be dividend rate. If you assume it to be dividend yield, your answer will automatically change over there, all right? So I'll just write down how much is the dividend rate they are saying over here. 25%. Payable before 31st March. So in bracket, I'm writing assumed to be dividend rate. So friends, if this is dividend rate, from this we can find out the total dividend amount due for 3 months, because we are going to enter into a future only for 3 months. Am I right? So that will turn out to be, what is the face value they have told over here? 10 rupee. On 10 rupee, you will have 25%. For 3 months will turn out to be how much? 2.5. No, sorry, you are not taking it for 3 months here. You're directly taking it for the total amount. Dividend amount due. There are two theories, friends. One, you can also take it for 3 months because your future price is only for 3 months. But here I think they have given a sentence very clearly that payable before 31/3/23. So it's that cash flow is happening in the next 3 months. All right. So do you get the answer as 2.5 rupees over here, friends? 2.5 rupees. Okay. Face value is not given. Okay. Advise the investor a course of action to be followed by him so as to earn risk-free income if he can sell the stock short at the spot price. So they're saying that whether he'll be able to make any profit or a loss. So first, even before we go to that, we need to find out the theoretical future price. Theoretical future price. Now tell me friends, what is the formula for future price? S0 into e raised to RT minus dividend is coming over here. So we'll call it as D into e raised to RT. Okay. Now, here I believe dividend is already payable on 31st March, payable before 31st March. So what I assume is it is happening as on 31st March. Okay. So the formula would be, what is the spot price that you have? Spot price is 220 into e raised to, what is the rate of interest told over here? 15% per annum. So for 3 months, it will be 3.75, 0.0375. Okay. Minus D into e raised to RT, 2.50. I'll not take e raised to RT because this is assumed to happen at the end. Okay. So now, for finding out e raised to 0.0375, we have to use a square divided by 2. I'll get the factor as 1.038203. Okay. Therefore, your future price will become 220 into 0.03 minus the dividend price of 2.5. Do you get the answer as 225.90 as a theoretical future price? Friends, I just want to cross check this answer with the solution. Let me just duplicate the tab here itself because I don't want to go, in a manner that is not as per your ICI material, because ultimately that's how they'll give you marks. So we can do it based on multiple assumptions. I can take it as dividend yield. Then the formula will change. Wait. 225.75 is what they have got. Correct. 2.5 they have taken. Okay, they have taken simple compounding. Okay, we have taken continuous compounding. Friends, continuous compounding is always better compared to simple compounding. That part is acceptable. I think we'll stick to this one. Okay. So you get 225.9. They have got 225.75. Just a 15 paisa difference. So once we get the theoretical future price, the next working note would be arbitrage. Okay, so here I'll write down point number A, theoretical F0. I think we have got the answer as 225.90. Okay. Point number B, actual future price. So what is the actual future price that's given in the question? 222. So now tell me, what is the status? Is the actual future price, actual F0 is undervalued or overvalued?
Undervalued by.
Undervalued. So what are you supposed to do? We are supposed to buy future. Okay. Everybody clear with this part? Okay. Now, once we have buying future, I'll have to give you the proof for this. Okay. Now let us see what is the requirement that they are asking here correctly. To earn risk-free income, if he can sell the stock sell the stock short at the spot price. So hold on. He is selling the stock short at the spot price. Hold on. I'll first give you the answer based on the correct logical flow. Then we'll cross-check with your study material answer. All right. So friends, there are two markets over here. Maybe I'll draw a line to segregate these two things. So here I'll put up the spot market. And here you will put up the futures market. All right. So now what has happened is, in the futures market, what is the action that we are going to do? Buy future. So in practical sense, what is going to happen is, we are going to buy future over here at what price? What is the actual F0? 222 rupees. Okay. Is this a real transaction or imaginary transaction? It is an imaginary transaction. Subsequently, over a span of time, what will happen? The futures will eventually go up to what price? It will eventually go up to 225.9. So futures will eventually go up to 225.9. At this point, what can you do? We can sell our futures. So when you sell your futures, you'll sell at what price now? You'll sell it at 225.9. So once you sell it at 225.9, you are going to make a gain over here. Am I right? How much gain are you going to make over here? You'll make a gain of 3.90. Is this gain real or imaginary? It will be your real gain. Ideally, this is how the future hedging or the speculation happens when it's undervalued or overvalued. But your textbooks have done some other methods or other course of action also. Let's just cross-check that now. Advise the investor the course of action to be followed by him so as to earn RF if he can sell the stock short at spot price. So they're talking about the spot market, if I'm not wrong. Sell the stock. So they are going to do a short selling at the spot price today. So what is the spot price today? Let us just understand that also. It is 220. So they are going to do a short sell at 220 rupees. Subsequently, what will happen? Let's just check the solution, friends, what they have done. Let's just cross-check. Short sell one spot at 220. Deposit at 15%. So you will get 15% interest on this. Okay. You receive this money plus 15% for 3 months. You will get 3.75%. So 220 plus 3.75%, you will get the price as 228.25. Correct? So I'll just add interest. So then you will have the closing balance will be 228 point. Buy a 3 months future contract for 1 unit at 222. I think that's something what we already have done over here. So they're going to sell for 220 and then they're using it to buy, but there's a 2 rupees gap that is coming in between. Fine, we'll ignore that for time being. Let me go to the next part. Take the money out of the bank after 3 months. You are withdrawing the money out of the bank, you'll get 228.25. Take delivery by paying 222 and return the unit of the stock to the party to whom the short sale was made. Okay. Pay the dividend to the buyer whom short selling was made. So how much dividend will be paid? So you will be getting 220, 228.25. That's the number that I've already got over here. So now since I've done a short selling, I will have to pay dividend. What they said is right, because the dividend will be paid to the person who is the rightful owner. So what is 228.25 minus 2.5? You're going to receive 225.75 over here. 228.25. Outflow would be 222 plus 2.5, 224.5. Okay, friends, here there is an incorrect point because what they are doing is they are comparing the spot market versus the future market. That is not correct. Why? I will tell you. So here, 1 minute. At this point, you are actually going to buy back. If you've done a short selling, after paying dividend, you will have to buy back at this price. So if you buy back at this price, hold on. 5.75 will be your 225. Friends, we have actually got the same profit. 3.75 they have got. We have got 3.9. That is only because of the difference that is coming up over the time value of money. That's all. They are also got 3.75 because if you take it in their method, here it will be 225.75. So arbitrager earns 3.75 without any risk. Friends, this step, ideally when you sell, at this point, you invest, you get 225, you pay minus this. So this is the money you will receive back in your hands. I'll explain to you. Receive in hand. So at this time, I have to buy back the share. Correct. So when I have to go and buy back the share, the buyback of the share will happen at 225.75 itself. This 225.75 is ignoring the time value of money. So your gain or loss over here will actually become 0. Okay, I think this way we get the same answer what your textbooks have got, but in a more logical way. Net gain is going to be 3.9. 3.9 is because we did continuous compounding. Your textbooks have not done continuous. compounding. All right, friends. So this is the answer. I'll give you a minute. Please write down. If you have any doubts, you can ask me now.
Sir, excuse me, sir.
Yes, Ramya, tell me.
Sir, in the previous question, only one doubt. Buy put means right to sell, sir.
Buy put means right to sell. You are buying a letter which will give you the right to sell the share.
Oh, buy put means right to sell. Buy call means right to buy.
Right to buy. Correct.
Thank you, sir.
All right, friends. I believe we are all done with this one. Okay. Can I go to the next one? This is the price without compounding. This is the price with the compounding. That is the only one difference that we have got. Okay. Right. Kathiravan, you want the MTP material? I'll share it with all of you. Okay. I'll share it.
Yeah.
Right. Can I go to the next one now? Okay. Right. So we are done with question number 4 also. Let us go to question number 5 now. Friends, 5 is a question on economic value added. Okay. So let's do it together. Question number 5. Working note number 1. Basic data. Particulars. You have orange, grape, apple. Orange, grape, apple. Okay. Total investment. Everyone tell me how much is the investment coming over here. You have 1 lakh, 1 lakh, and you have 1 lakh. Okay. Point number B, debt to asset ratio. So debt divided by asset ratio is 0.8, 0.5, and what is the other one? 0.2. From this, can I find out my total debt to value? That will be A into B. I'll get the answer as 80,000, 50,000, and the last one is what? 20,000. Okay. And they've given you the pre-tax cost of debt is given. Okay. So I think from this we can find out the interest amount, right? Pre-tax KD is given over here as 16%. You have 13%. And then you have 15%. Okay. From this, can I also find out my post-tax KD? How much will be my after-tax KD? 35% is the tax rate. You will get 5.6%, 4.55%, 5.25%. All right. Now, next one. Once you are done with this, they have also given you the KE. KE is given as 26, 22, 20. 26%, 22%, and 20%. All right. So, and they have given you the debt to asset ratio is 0.8 means equity will be 0.2. So, from this, we can find out the WACC, weighted average cost of capital. 5.6 into 0.8, 26 into 0.2. So, when you add up these two, you will get.
Excuse me, sir.
Yeah, tell me.
Post-tax KD, you've taken it as
Oh, I've taken it
5.6.
incorrectly. I should take
Yes.
it into 0.65, correct? Okay, thank you.
Yeah.
Thank you for correcting me there. It is going to be 16 into 0.65 into 16.
10.
That would be 10.4,
8.45,
8.45,
9.75.
9.75. All right. So once you get these numbers, the answer now would be 10.4 into 0.8 and 26 into 0.2. So do you get the answer as 13.52% for the first one? Second one would be 8.45 into 0.5 and 22 into 0.5. That will give you the answer as 15.2. 225. Right? Okay. Third one is going to be 1 minute. 15 into 0.2 and 9.75. Sorry, I took it wrong, I believe. I should take 9.75 into 0.2, 20 into 0.8. So I'll get 17.95%. Okay, so once we get the WACC, second part for me to find out would be NOPAT, net operating profit after tax. Have they given that directly in the question? Let's check. Okay, they've given us the EBIT. So I need to find out the EBIT into 1 minus tax, correct? How much is the EBIT? They have given 25,000 in all the cases. Fine. So once this is given, I'll find out EBIT into 1 minus tax. So 0.65 into 25,000 will be 16,250, 16,250, 16,250. Now what I have to do? I have to do investment, whatever is done, into the WACC. Am I right? So once I multiply the investment with the WACC, automatically what will happen? I will get the expected profit. So that will be 1 lakh is the invested capital into 13.52. That will be 13,520, 15,225, 17,250. So once we get this, I can go and work out my EVA, or the formula would be EBIT minus invested capital into WACC. So do you get the answer as 2730 over here? $1025. And the last one would be minus 1,700. All right, perfect. So now tell me, if based on this, first one you will buy, second one also you will buy, but last one you will sell because you are having expected profit of 17,000, but the actual profit you're getting is only around 16,000, friends. So you're not happy with that number. Everybody clear? Can I go to the next part now? Okay. So we are done with the first requirement of EVA. Let us read what is next. Compute the WACC, already done. Calculate the EBI, economic value added, already done. If the industry PE ratio is 11x of the stock price of orange, grape and apple are 14.3, 15.75 and 15.73. Calculate the number of shares issued by each company. Hold on. They have given you what over here? They have given you the market price and they have given you the PE ratio. So from this, we can find out the EPS. Am I right? Once you get the EPS, do we have the total earnings? Yes, I think we can find out the total earnings. For that, we have to reduce the interest and find out the EPS. Am I right? Okay. Based on that, we can find out the number of shares. So I'll do it separately. We'll write down the next working note heading. Number of shares. So we are having 3 companies over here: orange, grape, apple. Orange, grape, and the last one is apple. So here what I'll do, I'll write down point number A, MPS. So how much is the MPS they have told over here? 14.3. Second one is 15.95. And the last one is 15.7. Okay. They have given you the PE ratio is given. So from this, I can go and work out the EPS. That will be A divided by 11. Am I right? That's 1.3. Then it is 1.45. Then it is 1.43. Are you all clear with this part? So once you get the EPS, now what I need to do, I'll put the EBIT. EBIT, that is 25,000 for all the cases. Now from this, I need to reduce the interest, less interest. So how do I work out the interest? I have the pre-tax cost of debt as 16%. It will be 1 lakh into 80%, 80,000 into 16%. That will be 12,800. Second case, it will be 1 lakh total into 0.5 will be 50,000 on that 13%. That will be 6,500. And the last one is going to be 20,000 into 15%. That is going to be 3,000. So once I reduce this, I will get the earnings before tax. That will be 12,200. Here you will get the answer as 18,500. And here you will get the answer as 22,000. Now, once you get the earnings before tax, then from that I'll reduce the tax. That is 4,270, 6,475, and 7,700. Okay. So once I reduce this, what will I get over here? I will get the earnings after tax. That is 7,930, 12,025, and the last one is 14,300. All right. So this EAT once I get, now I can find out the number of shares. How will I do that? G divided by B. So that will be 7,930 divided by 1.3. So I'll get the answer as 6,100 shares for the first one. 12,025 divided by 1.45 will be 8,294 shares. Last one would be 14,300 divided by 1.43. That is 10,000 shares. Friends, just cross-check. Is there any mistake in the second one? I'm getting a rounded off number. Let's cross-check now itself. Now 6,100, 8,293 and 10,000. Perfect. We have got the right answer. All right. So this is how we will do the calculation of number of shares. Are you all clear so far, friends? Can I go to the next part now? Perfect. Perfect. So we are done with this one particular area also. Now let me check what next we can do. They are asking, advise whether the same industry PE ratio can be used to calculate the market price of the share of the company. Advise whether the same PE ratio can be used to calculate the MPS. Ideally, PE ratio is one of the methods, but here you have EVA also. So your EVA is turning out to be positive. Whenever your EVA turns out to be positive, ideally what happens is your market price also goes up to the extent of whatever is your EVA. So let's just cross check what solution they have given you in your books. Estimated stock price, number of shares. They have given you the market value. They have just directly multiplied. Come again.
Part 4, I think.
Part 4. Part 4, they just given you a heading that PE ratio should be adjusted to the risk factor. In reality, they are having different ways of risk. But more than that, they have EVAs. So now, for example, if you got the EVA as, I'm not sure how much you got for the first one, 2,730. So what would happen is your market price would actually go up to the extent of the EVA also. So you can just give a note like your textbooks have given, but in reality, EVA will also have an impact on the market price per share. All right. And the last requirement what they have over here is tabulate the market capitalization. So we'll just give you that also over here now. Market capitalization particulars. What are the names of the company? Orange, Grape, Apple. Yes, I'll just write down point number A will be MPS, that is 14.3, 515.95. And what is the last one? 715.73. Then we have to put the number of shares. Number of shares, and based on this, what can we find out? we can find out the market value. So the number of shares is going to be 6,100. Then you have 8,293. And the last one you will have over here will be 10,000. So the market value would be 87,230. 1,32,273. And the last one is 1,57,300. I'm just writing it down because don't need to do the calculations on my own. So friends, we are done with this question also. Take a minute, understand this entire thing. If you have any doubts, you can ask me. Friends, I'll just get some water and come back.
Can you
Yeah, tell me.
can you please explain the fourth requirement?
Okay, the fourth requirement, what they're asking is, okay, since the three companies are waiting, I'll just read the question first. Advise whether the PE ratio can be used to calculate the market price of the share. Okay. How do you find out the market price of the share? One of the methods is EPS into the PE ratio. Am I right? Now here, they have told in the question, how much is the PE ratio they have told? Industry PE ratio is how much? 11x. So when you talk about the industry, the PE ratio is 11x. I agree with you. But now here we are having three different stocks. That is orange, grape and apple. Formula for orange will be EPS of orange into PE ratio of orange, not the PE ratio of the industry. Now suppose orange is more risky. So they may have a 12x PE ratio. Suppose grape is less risky. It will have a lower PE ratio. Suppose Apple is working exactly as how the industry is working, then Apple will be EPS into 11x. Are you clear with this part? So you can say that market value will change based on risk. Not only this, friends, if EVA is positive, what will you do? Will you buy the share or sell the share? You will buy. So automatically what will happen? The price will go up. If EVA is negative, what are you supposed to do? Sell. Then what will happen? The price will eventually go down. Are you clear with this part now, friends? Okay.
Yes.
Right, perfect. Just give me 1 minute. In the meanwhile, you try doing the next question yourself. It's a question on Forex. I'll just get some water and come back. Question number 6. Friends, I'm back. Shall we do this problem together now? Okay. Yes. So I'll write down over here 1 minute. Perfect. So we'll start with basic data. Question number 6. Working note number 1, basic data. JKL Limited, an Indian company, has an export exposure of 100 lakh yen. So it's an Indian company, right? So it is a receivable. How much is a receivable they have over here? Is it turning out to be 100 lakh yen? Correct. On December 31, 2022. Yen is not directly quoted against the rupee. The spot rate is given. Spot rupee per dollar is given over here. That is turning out to be 82.22. 82.22. Then they have given you the yen per dollar, 132.34. Spot yen per dollar is 132.24. It is estimated that the Japanese yen will depreciate to 154. So, point number D, estimated yen per dollar is going to be 154 yen per dollar. Okay. Next one, they have told Indian rupee to depreciate to how much? 85. So, estimated rupee per dollar is going to be how much? 85 rupees per dollar. All right. Forward rates are given below. So what is the forward rate? 86.5. So forward rupee per dollar is 86.5. Okay. And they would have given you the forward yen per dollar also 140.35. All right. So they have given you all the basic information over here, and they're asking you the expected loss based on the estimated rates if the hedging is not done. Justify the decision to take the forward cover even if the actual rates happen to be as follows. They have given you more rates over there. So let us start with the first one. Loss if hedging is not done. How do you find out the loss if hedging is not done? We have to find out, okay, amount receivable in case of forward contract, how much you will get under forward versus how much you will get under estimated. Okay. So now everyone interact with me. In order to take the forward contract, first thing that I need over here is my desired rate. Okay. Everyone tell me what is my desired rate over here. I either need rupee bar yen or I need yen bar rupee. But in the question, have they given you rupee bar yen directly? No, they have given you rupee per dollar. So I will have to go by the 4 steps of cross rate. What are the 4 steps of cross rate? Desired rate, bid or ask, cross rate, and conclusion. Correct? So now tell me, friends, will it be bid rate or will it be the ask rate? Come on. What are we going to do over here? We are going to receive yen and then we will sell yen. In return, I will buy rupee. Sell rupee, buy yen, rupee bar yen. So here the commodity is yen. You're going to buy yen. So what rate is applicable? Bid rate is going to be applicable. Okay. So once you get the bid rate, I will go to step number 3. What is going to be step number 3? Cross rate. So I need bid rupee bar yen will be equal to what? Bid rupee per dollar into bid dollar bar yen. Now tell me, have they given dollar bar yen or yen bar dollar? They have given yen bar dollar. So I should do what? 1 divided by interchange. So how much is a bid rupee per dollar in the forward case? Oh, they don't have bid and ask over here, is it? I simply wasted our time. Okay. So that's not required, but that's how in reality you should be doing it. That's okay. I think we did in an advanced level. So 86.5, I will do into 1 divided by 140.35. Do you get the answer as 0.6163 rupee bar yen? Okay. Then I'll finally go for the conclusion. Okay. Now tell me what will be the conclusion over here. How much is the yen I have a receivable of? 100 lakh into 0.6163. Correct? So I'll get the answer as 61.63 lakh rupees. Okay, this is the answer I get under forward contract. Now I'll write down the next working note. Estimated amount receivable if no hedging is done. So friends, now the calculations become easy. I don't have to do the 4 steps. I can directly just take the rate and multiply it. All right. So what were the numbers I had for estimation? 154 and 85, correct? So the formula would be 85 into 1 divided by 154. Do you get the answer as 0.5515 rupee per yen? Into I will do 100 lakh yen. So it will be 55.19 lakh rupees. Then we will write down gain or, estimated loss. If I don't do hedging, I will get only 55.19. If I do hedging, I will get 61.63. So what is the loss I do by not entering into hedging? Do I get the answer as 6.44 lakh rupees over here, friends? Am I right? Let's cross check with the answer in your text, in your RTP. $6.94 lakhs. How much did we get? 6.44. Hold on. 55 lakh 19 is correct. We got 61 lakh 63. They got expected loss without hedging. Wait. Hold on. Let's just cross check. 82.22, 132.34. That's exactly what we have done. Did I take any? Is there any calculation error? Wait. 82.22. Did I take a wrong number? 86.5. So they have done it based on the spot rate, is it? The money receivable today is what they have compared. Okay, fine. Friends, there are different ways of comparison. All right, there are different ways of comparison. They have taken the spot and they have compared with the forward. What I did was, if you do hedging in forward, you get this much. If you don't do hedging, you get this much. This is also a more logical answer. Okay, we will just and because the money is not receivable today, it is receivable after a particular period. So let's stick to a logical answer, friends. That will be simply confusing because you are anyways not receiving money today. Okay, so let's skip the way your textbooks have done. We'll do it in the correct way. Next question. Justify the decision taken to take the forward cover even if the actual rate happens to be as follows. Now, these are the actual rates. So let us just write down the next working note. Actual amount receivable. Actual amount receivable if hedging is not done. If hedging is not done. Okay. So now here what I will do, I'll first take the numbers. What are the numbers they have told? That is 86.25 into 1 divided by 140.85. Do you get the answer as 0.6123 rupee per yen into 100 lakh yen? So the amount I would receive is 61.23 lakh rupees. All right. Therefore, Even then we have an expected loss, because if I enter into a forward, I would be getting 61.63 minus. Here I am getting 61.23. So do I get the loss of 40,000 rupees even if the actual price turns out to be this much? Let us check how your textbooks have done it. They have got 50,000 at the time of export 0.6213. I think they have again taken and compared with the spot rate over here, is it? Friends, when you compare with the spot rate, it's called as transaction exposure. It is not the expected loss. And loss can be compared only if you're doing hedging versus no hedging. So this is a more logical answer, friends, 40,000. Can you please scribble it down? I'll give you a minute, then we go to the next question.
Sir, in
Yeah, tell
exam,
me.
if we do like this, it was fine, right?
See,
Like,
when you do like this in the exam also, if you're giving your answers very logically and explaining why you're doing it this way, am I right? Correct?
yes, sir.
So, expected loss can be calculated in multiple ways. If I hedge, I get this much. If I don't hedge, I get this much. So, that difference is your expected loss. Today, if I receive, I get this much versus I would have got that much is transaction exposure. This is actually not correct. Now,
Exactly.
that
So
puts me
if
in
we
a
do
fix.
this and if we mention out the note, it will be fine.
You can do one thing and put it, just can give
Definitely.
a note. Alternatively, we can also compare it with the spot and you can do it. That's also one way of doing it. But logically, this is the
Okay.
correct answer.
Yeah, sir.
We
Okay.
come to a fix many a times like this. Yeah.
Yes.
Sir, excuse me, sir.
Yes, Ramya, tell me.
Sir, actually, if hedging is not done means actually I am going to receive after 3 months. So that 3 months spot rate only have to be taken, no, sir.
That's exactly what we have taken.
So 40,000 is the correct answer only.
It should this is the correct answer. But your textbooks have done it in a different way. The RTP has done it in a slightly different way. They are comparing with the spot.
Spot of the transaction date.
The transaction date. The first day when the sale has happened, that day anyways you will not receive any money.
Okay, sir.
Ideally, if that is supposed to be taken, the terminology to be used should be transaction exposure. Profit now versus profit later.
Sir, yes, sir. Thank you, sir.
Thank you. Rahul, unfortunately, that's true. Material has got many areas like this where, answers are actually supposed to be one, but they do it in a different manner. Okay. Can we go to the next question now? Next question is a question on money market hedging. Okay. So let me put up the basic data. Okay. Point number 8. Here, you are an exporter and the invoicing amount is $7 lakh. So what is the amount that is receivable by you? The amount receivable by you will be $7 lakh and the credit period is how many months? Credit period is turning out to be 3 months. All right. Exchange rate is given, the spot rate is given, the forward rate is given. Friends, I think the exchange rates are exactly the same as what we have done in our class. And the amount in our class was 3 lakh 50. They have made it 7 lakh. Deposit rate is given, borrowing rate is given, and they're asking you to do a money market hedging. So friends, as I always do in my classes, we'll start with a diagram. And after the diagram, we will go and solve it in a proper manner. All right. Srinath, you can give a diplomatic answer. Either you go as per your RTP. Okay. For my objective is to explain the logic part also to you. You can go as per the RTP. Option 2, you do it in my method and give a note. Alternatively, it can be done like that. It's up to you. Right. So now here, friends, if it is a money market hedging problem, we have a receivable over here. There are two countries. I'll put two boxes. What are the names of the two countries over here? UK-based exporter exports goods to USA. So UK, here you have US. Okay. So for the UK fellow, it is a receivable. So hence what will he do? He will create a payable. How will he create a payable? He will borrow some money which along with the borrowing rate in US, that is the loan rate is 9% for 1 year. I think the duration is 3 months. So what is 9 into 3 by 12? 2.25%. Would turn out to be how much, friends? $7 lakh. So can you do a reverse working and tell me what you will get over here? 6 lakhs, 84,596. Okay. So once you get this amount, what will this X do? He will take this money and he will bring it to UK, correct? So now he has dollars, he's going to bring it to UK and he's going to sell the dollar. When he's selling the dollar to the bank is going to buy dollar and the bank will sell pound. So bid rate or ask rate, pound is the commodity. It will be the ask rate, 1.5905. 1.5905. So you will get the pound receivable as 4,30,429 pound, correct? On this, we will add interest. How much is the interest that you will get in UK? 5% into 3 by 12 would be 1.25 percentage. You will get the answer as 4,35,809 pound. So this is the money that will be received by me, and this will be paid by whom? It will be paid by my customer. Okay, I'll give you a minute. You can scribble down the diagram.
Sir, can you tell me how you got the 2.25%?
I'll explain that to you, friends. 1 minute. All right, 1 minute. Okay. See how you got the 2.25 is we are going to borrow in US. Am I right? So in US dollar, you are having a loan amount of 9% for 1 year. So for 3 months, it will be 9 into 3 by 12. That is 2.25.
Thank
Okay.
you, sir.
Thank you. Right. So friends, once you are done with this, what we'll do is we'll have to give the steps. Exam diagram will not help you to get marks. So what is step number 1 that you will write down over here? We will have to, since UK based company, since UK based company has a receivable, they will create a payable by doing what? Borrowing in dollars. Dollars to borrow would be 7 lakh divided by 1.0225. That will give you the answer as how much? 684,596. Then what will you write down? $684,596 will be converted into 4,30,429 pound at the spot rate of 1.5905. Then 430,429 pound along with 1.25% will increase to this much. This will be received by the UK company. Last point, point number 5, okay. 684,596 will increase to $7 lakh, and this will be settled by whom, friends? Settled by the customer. So like this, in 5 steps, you're supposed to write to get marks. Okay. I'll share all these notes with you. Just scribble for time being and understand the whole thing. Then exam point of view, I'll be sharing this entire notes with all of you. Okay. All right, friends. Are you all done with this part? Can I go to the next one now? So we are done with question number 7 also. Let us go to question number 8. Friends, 8 is a question on sensitivity analysis, advanced capital budgeting decision. Okay, right. X is considering its new project with the following details: initial cost, annual sales, selling price, then you have variable cost, fixed cost per year, and the discount rate is given. Okay, so from this, I believe we need to work out the NPV first. So I'll write down question number 8, working note number 1, NPV. So I'll draw a table over here. Here, cash flow, discount factor, discounted cash flow. Initial capital cost is how much? 400 crore. Annual sales is 5 crore units. 5 crore into 100 minus 50. That will give you the contribution. So 50 rupees into 5 crore will be 250 crore. Minus fixed cost is going to be 50. Remaining will be 200 crore. Have they given anything about taxation? No. And what's the life they have told over here? Haven't they given the life? Life is 3 years. Okay, so it will be 3 years, they'll be getting 200 crore. Year 1 to 3, they'll be getting 200 crore. And the discount rate is how much percentage? 6%. I'll put a star for this one. I'll come over here. How did I get this 200 crore? I did 5 crore units into 5 crore units into what? 100 rupees minus 50 rupees. 100 rupees minus 50 rupees into, that is 50 into 5 crore, that will be 250 crore, minus 50 crore. Minus what? 50 crore. Okay, so you'll get 50 into 5 crore, that is 250, minus 50 would be 200 crore. All right. Now, friends, what will be the discounting factor? Can you tell me? Do you get the number as 2.67? That will be 534 minus 400. And your NPV will turn out to be how much, friends? It will turn out to be 134. Wait, Katiravan, I think the bank deals with pound. So it should be ask rate. That's what I have taken. Question 7, we have taken ask rate only, Katiravan. Right. So you get the NPV as plus 134 crore. All right. NPV is positive as of now. Tabulate the NPV. Does it represent the actual outcome? Friends, is this the actual outcome or expected outcome? This is your expected outcome. We are expecting that we'll invest 400. We are expecting that I'll get 200 crore every year. And that's how my NPV becomes 0. Not 0, it becomes plus 134. If any of the parameters change, automatically my NPV will also change. So let's check that now. So down they are saying, examine the impact of 2.5% adverse variance in each of the variables of the project's NPV. Decide which variable is having maximum effect. So tell me, friends, here they want me to make a calculation with a 2.5% adverse variance. So what are the parameters that we can consider over here? Can I find out the sensitivity for initial outlay? First one, we can do it for initial outlay. All right. We can do it for initial outlay. We can do it for cash inflow. We can do it for discounting factor. I'm not sure how to do it for life. Life, maybe with 2.5%, we'll have to reduce the cash inflow and do it. Okay. Let's do it for initial outlay first. So friends, here what will happen here? Okay, year 0. Now your investment is going to go up by how much? 2.5%. So 400 plus 2.5% will make it 410. Correct? Year
Sir,
1 to
adverse venom we have to do, no?
come again.
No, it is 2.5% in adverse variance means 400 minus 2.5 is not, sir.
No.
We have to-
Investment coming down, your NPV will go up. If the investment increases, only then your NPV comes down. Correct? What is adverse? Investment going up or investment coming down?
Coming down only, no, sir.
Coming down is very good for you, no?
Going up.
400 crore, then you have to invest only 390 crore. Very good. You are investing less money. Outflow
Okay,
should
sir.
increase.
Thank you, sir. Understood.
Okay. All right.
Understood, sir. Thank you so much.
You are clear, right? Okay, 1 minute. Let me just continue. So we were doing this, so it will be 410, but year 1 to 3 will remain the same. What is the discounting factor that they have told in the question? 6%, correct? So now tell me, here it will be 1, 2.67, 410. So this one will be the same, 534. So now what happens to your NPV? Your NPV will be 534 minus 410, it will be 124. So now what has happened? Increase your, so now in order to find out the sensitivity, we would say 2.5% was the change in your investment, correct? Divided by what is the change in NPV that you have found out over here? Change in NPV. Earlier it was 134. Now it has come down to 124. So from 134, it has fallen down. So NPV has changed by 7.46%. Correct? So I'll put it this way. 7.46% change in NPV due to 2.5% change in investment. So tell me what is the answer you get over here? Do you get the answer as 2.98% as the answer over here? Correct? Let's just check how your textbooks have done this. Friends, hold on. Here we got the answer as 4,35,808. 4,35,808 for the previous question. Yes, we have got the same answer. Okay. They have found out a gain also over here. Friends, ideally you will not have gain because the objective is hedging. You are doing this to sleep peacefully. Okay. They have done it in one shot. Let's see what's the answer they got. They have taken the cost increase to 410 crore. Selling price, etc. will remain the same. Number of units 250, 200. Present value of cash inflow 124. So they have just found out 7.43. That's all. They have not done anything more. But actually, we should do what is the change in NPV for every 1% change in every parameter. So here, actually, the sensitivity is how much? 2.98. What is the logic of this 2.98? For every 1% change in investment, NPV is changing by how much? 2.98. All right, friends. So like that, we did for initial outlay. Now I'll write down the next one. Okay. Sensitivity in case of what are the other parameters, friends? I think they have given you the units are given, selling price is given, variable cost is given, everything is given. So let's do it based on units. Here, cash flow, discount factor, discounted cash flow. Sorry, friends. Year 0, you have an investment of 400. Now what will happen? If 5 crore is falling down by 2.5%, you will be selling 4.875 crore units. Okay. 100 rupees minus 50 rupees. So this into 50, that will give you 243.75 crore. From this, you will reduce what? You will reduce the fixed cost. How much was the fixed cost in the question? 50 crore. So once you reduce this, what is going to be your inflow now? 193.75. So here I will get 193.75. 1 will get 2.67. That is 517.90 minus 400. 117.90 crores. All right, that is going to be your NPV. Earlier, what was your NPV, friends? 134. So now here it will be 134 minus 117.9 divided by 134. Here I get a change of how much percentage, friends? I get a change of 12% over here. Everybody clear with this part? Let's check if that's the same answer your textbooks have got. Yes, they've got 12.41. That is for variable cost. Units sold per year reduced to 4.875 crore. 12.41%. Okay, we got 12. I've just rounded off the numbers. Friends, are you clear with this part? Like this, we are supposed to do the others also. So we'll do the selling price now. Next working note. Sensitivity in relation to selling price. Again, I'll draw the table here. Cash flow, discount factor, discounted cash flow. Here 0, your investment is going to be 400. Here 1 to 3, we need to find out. So now it is going to be 5 crore units into 100 will come down by 2.5. It will become 97.5 minus 50. That is 237.50 crore. Minus what? Minus 50 crore. You will get 187.50 crore. Okay, and what is the discounting factor that you have? 6%. What will be a PV factor? 2.67. Do you get the answer as 500.625 minus 400? So your NPV would be 100.625. So now it will be 134 minus 100.625 divided by 134. Here I get the answer as 25.83%. Shall we cross check? 25.83 they haven't got. Selling price reduced. They have got the answer as 24.82. Little difference, friends, I think. That's a rounding off error. We got 100. That's a rounding off error. So we can ignore that part. So 25.83 is the answer that you will get over here. Now, friends, next thing would be what?
Sir.
Variable cost.
Sir,
Yeah, tell me.
sir, our answer should be 24.9, no? It's not
Did-
25.8.
Did I make any calculation error over here?
I think yes, sir.
You're not audible.
Yes, sir, it is a calculation error. The
Okay.
answer is 24.91, sir.
Hold on. 100.625 divided by 134. Okay, 24.90. That was a calculation error. Thank you so much. 90. All right. Yes. So, friends, I think if I do variable cost also, we should get the same answer only because no, we'll get a different answer. Okay. So now I'll write down the next working note. Sensitivity in relation to variable cost. I'll write down here cash flow, discount factor, discounted cash flow. Here 0 is 400. Here 1 to 3. Now you will have 5 crore units into 100 minus, what is 50 minus 2.5%? 48.75. 256.25 minus 50 crore will be your fixed cost.
So we need to increase the variable cost.
Oh, yes. Thank you for correcting me again. I'm making mistakes here. So it will be 50 plus 2.5%. That is 51.25. Correct. So 100 minus 51.25 into 5 crore will be 243.75. Minus 50 crore when you do 193.75. Am I right? And your PV factor is going to be 2.67 minus 400. So that's 517.31. 117.31. So then the formula would be 134 minus this divided by 134. Do you get the answer as 12.45% now? Let's cross check. I think they have not done variable cost, or variable cost 51.25. They have got the answer as 12.41. We got 12.45. Okay. Perfect. So friends, I think we have done all the parameters given in your textbook. We can do more actually. Initial capital we told, selling price, variable cost, fixed cost, units sold. These are the parameters done in your RTP. I can do it for discount factor. I can do it for life also. But this is enough. If this much is what they have given, then this would be sufficient for us to do it right now, friends. Okay.
Sir, excuse me, sir.
Yeah, tell me.
If for discount factor mean we should increase the discount factor or decrease?
Discount factor means you should increase.
Increase means NPV should get reduced,
NPV should get reduced. Exactly.
For life means
Life decrease.
2.5% decrease.
Yeah. See, life, how we'll do is, if life is 3 years right now, okay, you want to decrease it, automatically what will happen? Your cash flow for year 3 will decrease.
Oh,
Now it's 200, right? So 200 will be for year 1, 200 for year 2. Year 3, the 200 you reduce it by 2.5%. It will become 195. Because if the life decreases in third year, automatically what will happen? Your cash flow for the third year will also come down. Am I right?
okay, sir. Okay, sir.
Like that, you will have to work it out. Okay? Right.
Sir, I have one more doubt. Not the whole 3 year we should reduce the 2.5. Only for the third year, what is that?
Okay, I'll explain to you. Life is 3 years, right? 3 into 365 is how many days? 1095 is the current days.
Yes, sir.
Minus 2.5%. Right now, the life is 1095 days. Correct? Minus 2.5% will give you 1067 days. All right? In this, 365 would be year 1. Okay? Another 365 would be year 2. So that is 730. Okay, gone. And then balance 337 days will come in year 3. Are you getting my point? Okay. So here, your cash flow will be 200 lakhs. Here, your cash flow will be 200 lakhs. Here, your cash flow will be 200 lakhs is coming in 365 days. You will take it for 337 days.
Okay, sir. Understood, sir. Now.
It will be 184 crore or something like that will come. Okay.
Thank you so much, sir.
Thank you. Thank you, Ramya. Can I go to the next part now? Right. So I think we are clear with this question on sensitivity. Can we go to the next question? Question number 9. How many questions we have? We have 10. Okay, we have 13 questions. We have read 9. That's good speed. We'll do one more question and then we'll take a break, friends. After the break, we will, in the second session, we'll pack up with the RTP part. Okay? Right.
Excuse me, sir.
Yeah, tell me.
So for a minute, could you just go back to the previous slide, please?
Yeah. You want this one?
Okay. Yes, sir. Got it, sir. Thank you.
That? Okay, 1 minute.
Excuse me, sir.
Yeah, tell me.
Sir, you had told this just now, but I missed that part. The discounting factor, sensitivity to discounting factor, should we increase it, sir?
You should increase it, because when you increase it, only then your NPV comes down.
Okay, sir. Thank you.
Thank you. All right, friends. So we are done with this part also. Now we will do this question. A and B. They intend to borrow $2 lakh and 2 lakh. Friends, this exact question is done in our class also, but we'll do it again. Intend to borrow $2 lakh and 2 lakh in yen for a time horizon of 1 year. All right. So now when they say intend to borrow, I will put the question number 9. We'll write basic data.
Chapter is 4x, right?
One moment. Pratik, are you speaking to me?
Yes, sir. Chapter names of 4x, right?
Chapter name is interest rate derivative. Okay. It's an interest rate swap problem. They're saying A intend to borrow $2 lakh. So when they say A intend to borrow $2 lakh means he is currently borrowing in what? He is currently borrowing in yen. And when they say B intend to borrow in yen means currently he is borrowing in dollar. All right. Yes. So that one thing we have understood. So A wants to move to dollar. So A wants to move to what loan? Dollar loan. B wants to move to what loan? Yen loan. Everybody clear with this part now? Okay. Right. Now I'll go to the next one. So based on this, we'll do all the steps, friends, which is required for swap. That is interest rate differential, gain of each party, and then we will do swap. All right. So friends, I'll just write down the next working note heading. Interest rate differential. All right. So here I'll draw a table, particulars. Particulars. You are having yen loan and then you are having dollar loan, correct? So A is there and then you have B. So there is 5 and 8. And here you have 9 and 10. So first I will take the difference over here. That is 3 and 1. Then from this I will take the net difference. What is the net difference? 2%. Friends, from this 2%, A will have a share, B will also have a share. How much share is there is not given directly, but it is given indirectly. They have come down and they have told over here, if you read through this part, they have told B will pay to A 1% over the yen interest rate. So why would B pay to A 1% over the yen interest rate? That is because the share of profit of A is going to be how much percentage? 1%. So I'll just write down that also over here. So here you get the share of profit of both the parties as 1% and 1%. Why you get that is because I'll just give a note over here and write down, since B will pay to A 1% over the yen interest rate, it means share of profit of A is how much percentage, friends? Share of profit of A is turning out to be 1%. Everybody clear with this part now? Okay, I'll just go down. Yes. I think you're done with this. So once we are done with this, then we have to go and do the swap. So when I do the swap, we are having two parties over here. A is the strong party and B is the weak party. How did I know that A is a strong party? That's purely because A is able to demand a lower interest rate. Now everyone tell me, currently is A paying dollar loan or yen loan? Currently A is paying the yen loan. So how much is he paying over here? He is paying 5 over here. And B is currently paying dollar loan over here. Now what will happen? There is going to be a swap. So when the swap will happen, what will happen is A is going to receive 5% from B. A will receive 1%, but A will pay back only his own dollar loan. That's how the swap is always arranged. His own dollar loan is how much? He'll pay back only 9%. Whereas B will pay 5%, B will again pay 1%, and B will receive 9%. Okay. Once you do the entire thing, what is the net settlement? Receive 6, pay 9. So net effect is pay 3. Here it will be receive 3%. All right. So when you look at the conclusion part, what will happen? A's point of view, in order to do the swap, A can go to his own bank. If he goes to his own bank, he will end up paying 9%. Instead of going to his own bank, he can go for a swap. If he is going for a swap, what will happen is he's already paying how much percent to his own bank? 5. 5 to own bank plus 3% is going to pay as what? net settlement. Total, how much is he paying? 8%. So what is the gain that he's making over here? He's making a gain of 1%. Same way for B, also there can be two scenarios. One, he can go to his own bank or he can swap. If he is going to his own bank, B converting into dollar loan, he will end up paying how much percentage? 10%. Instead, when he went for swap, he's already paid 10% over here. Hold on, I've made a mistake. A is intending to convert into yen loan, right? So B for yen is going to be how much? 8. Now he will receive how much from A? 3%. So net he will pay only how much? 7%. So when you see the net gain or loss over here will turn out to be how much percentage, friends? It will be 1%. Okay, so both of them are actually making the same profit. So in exam, we will have to give it step by steps. So I'll write down steps of A, steps of B, particulars. Then I will write down in percentage. So first, what will A do? He will pay to his own bank. Now tell me, friends, how much will he pay to his own bank? 5. Then he will receive from B. How much? 5. Then he will receive the share of profit also from B, that is 1. And then what will he do? He will pay 9. So net, how much did he pay over here? 5 gets cancelled. He ended up paying 8. Or his gain over here will be, he would have paid 9. Now he's paying 8. His gain is 1%. Or $2 lakh is going to be his loan amount. At 1% will turn out to be how much, friends? $2,000. In the same way, we will have steps for B also. First, B will pay to his own bank. How much will B pay to his own bank? 10. Then B will do what? He will pay to A. How much? 5. Again, he will pay to A how much? 1. Then he will receive from A how much? 9. 9. Am I right? So here, what is going to be his net payment? 15, 16 minus 9, he will end up paying 7%. And his gain is going to be 1%. So, on a total of $2 lakh, 1%, and now he is into yen. So, it will be converted into yen. So, he will end up paying 2,40,000 yen. Perfect. I'll give you a minute, friends. Absorb this whole data. If you have any doubts, please ask me.
Can you move a screen little down the last session?
Please repeat once again.
Can you move the screen little down in the last?
Yes. Is it visible now?
Yes, sir.
Sir, excuse me, sir.
Yes, tell me.
In B's case, first he is paying to his own bank. Next he is paying to A for 5%. Again, what is 1%, sir?
Share of profit.
That 5% is actual interest.
That is the actual interest that he is paying to his own bank.
Okay, sir. Okay.
The other 1% is the share of profit.
Okay, sir. Thank you, sir.
All right. Fine, friends. I believe you are all done so far.
So
Yes.
one doubt.
Yeah, tell me.
So in the previous slide, when we no, the next slide, sir.
The next one, you mean this one?
Yeah, yes, sir. So when B is paying to his own bank, so that is 8% is will be the what when he is intending to borrow it, right?
When he's anyways intending to convert into dollar. Am I right?
Right, right.
If he goes to his own bank and asks for dollar loan, he has to pay 9%. Now, if he's doing for a swap, he will just pay 5% to his own bank and plus he will pay 3% to B.
Right.
How did you get the 3% from here?
No, got it. I got that.
So he's ending up paying only how much? 8.
Hmm.
So had he gone to his own bank, he's paying 9. Here he's paying only 8. So he's saving how much money? 1%.
1%. And in B's case, sir, for his own bank, he has to pay 8%. So he's currently in a yen loan and he wants
Exactly.
to, sorry, he's currently in dollar loan and he wants to convert to yen, right?
Correct. So
So
if he goes to his own bank and asks them that I want to convert into yen, okay, they will ask him to pay 8%.
right.
But instead, if he goes for a swap, he will pay 10% to his own bank, plus he will receive 3 from A.
Got it.
So he's paying only 7.
Okay. So he'll again save 1%.
Yes.
Got it, sir. Thank you.
All right, friends. Shall we take a break now? So, friends, I think we have covered quite a lot of problems in the first session itself. We have covered 9 questions. We'll take a break of 30 minutes, friends. I need the video to get buffered and saved. After that, we will do the remaining questions and we'll pack up with RTP in the next session itself. Then we will go into MTP. All right, friends? Yes. Okay, Catherine, I'll share the MTP in the mentoring group right away now. All right? Fine. Thank you so much, friends. See you after the break. Thank you.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you.
Sir, how long is the break?
We'll take a 30 minutes break now. Okay? Okay. Thank you.